We are live on Facebook. People keep joining us. And I'm very much excited that Steve Hoffman agreed to join our webinar. And he will talk about 10 commandments of how to raise capital in Silicon Valley and in China. And Steve, you may not remember me, but we met with you like in 2014, I think, at Angel Hack. You were one of the judges, and I was joining some teams, building some product at the hackathon. It was pretty awesome, and we were receiving some feedback of yours. It was pretty cool. So I'm going to share a few slides. I'll present you, and I'll let you present yourself in a broader way, so we can have all details about your expertise and experience. Just 1 second, sharing the slides. All right, so this is the special webinar today. Steve Hoffman is I would say, celebrity, especially in Silicon Valley. He's a known venture capital investor and a founder of Founder Space, an accelerator that helps companies to actually grow and achieve results. I think one of the very important topic here Steve can cover not only Silicon Valley but also China, because he has expertise in that market as well. China is a very specific market, and what applies, for example, to United States won't apply to China, as far as I would understand that. And those insights would be very helpful. Also, Steve was an angel investor and LP in August Capital. He's a serial entrepreneur and he's an author. He wrote, I think, a few books, and you may correct me, and I'll let you present those books. It would be very interesting to know how elephants can fly. And I'll let you speak in a second. This is all under Go Global World community. A non-profit community uniting English-speaking entrepreneurs from around the world to help them to connect and get closer to capital, like-minded people, and access to very strong network. Your role as a member of the community is to help each other to get to global markets. And this is our past speakers from recent events, and there were like already almost 30 webinars from Silicon Valley. We had amazing people joining us, like Bob Dorff, like Bill Reichert, Ilyas Tribulaev. A few days ago, we had our first live pitch to global investors, and we had startups pitching that achieved $1 million in revenue and more, and they are entering the United States. So it's very interesting what's happening right now with startups outside United States, and those kind of startups have a lot of potential to skyrocket in the United States and go global. But it's not only limited to those people. Our ecosystem helps entrepreneurs at all stages, and we are happy to help even those who are in remote locations, especially those who don't have any access to knowledge, expertise, and this is why we do these free webinars, so people around the world can build businesses. Our next speakers, upcoming speakers, two ladies from Google. They will be talking about being different makes a difference, working in multicultural teams. Diversity matters a lot in the United States, in developed countries. This is why we will touch a lot on this and how it can help your businesses growing. Then we will have a special talk with 500 startups. They will explain how to get accepted into a newly formatted program. We also will have a special talk about Silicon Valley and human innovation and design experience in the past, present, and future. There will be special guests like Natalia Polyavina, Michael Shanks, Victor Taratuhin, all people from, they are all from Stanford and also connected with SAP, and they will talk on this topic. Also, we will have a third part of the history of Silicon Valley. It was very interactive webinar with David Duchovny. It will be in Russian, but with English subtitles. So it's very interesting, very interactive, so I recommend to join. Another webinar will be in Russian about regulatory requirements for the United States, for startups entering the United States. And we'll try to help you clarify all those aspects. Also, there will be another webinar also in Russian, the future of electric cars and how to raise capital in this kind of very complex segment. And Mikhail, the MBA, Stanford MBA, he will explain how he does it and so on. So we will have a Go Global World monthly meetup with founders from different countries. It will be in early July. Join us if you want to connect and network with the founders that can help you to enter their markets and go global. Another similar webinar will be also in Russian. Just for those who struggle speaking English, I will help. It will be also a networking session. So if you like our events and you would like to join future events with great speakers like Steve, like others I just spoke about, just scan this QR code and it will take you to our Eventbrite page and you can register. On this note, I present the main speaker and the main person of today's webinar, Steve Hoffman. And I'm really excited again. And Steve, I'm giving you a word, and please give a few words about yourself, about your book. And it's now, just feel free to continue.
Wonderful, thank you. It's great to be here, Daniel. Great to reconnect. And I'm very happy to be helping Russian entrepreneurs. So I'd love to come to Russia sometime and meet you and collaborate there. I do a lot of work globally. Founderspace, I will tell you a little about Founderspace. I have an introduction in my presentation, so I'll go over that, and then we will launch into the 10 commandments of raising venture capital. Now, these commandments are all the rules that I learned the hard way. So I have been an entrepreneur. I have founded 3 venture-funded startups and 2 non-venture funded, 2 bootstrapped companies. And I have raised a lot of money for my own companies, as well as working with other entrepreneurs. So I work with hundreds of entrepreneurs all around the world, and I help them. We invest in them. Founderspace invests in them. We have our partners invest in them. But even more importantly, we help guide them through the whole process. So there's a lot of intricacies in raising capital, and it's very market specific. You know, if you're in Silicon Valley, there's one way to raise capital. And if you're in another country, it's very different. So in today's talk, at first, I'm going to focus mainly on the strategies for Silicon Valley, because it gets very confusing if I do 2 countries at once. So I'm going to focus first on Silicon Valley, and then in the QA session, I can talk about China, because Founderspace does a lot in China. We have incubators all across China, you know, in Hangzhou, Shenzhen, Xi'an, Nanjing, Wuhan. So we're all over China working with startups. And if you have a startup that wants to come to China, we're probably a very good choice, because we tend to be an international gateway and really helping startups from all over the world come in and connect with Chinese investors and develop go-to-market strategies in China. So the second half, when we go into Q&A, feel free to ask me any questions you have, and I will tell you everything I know about entering the China market and raising capital there. So I am in Silicon Valley now, just so you know, and I will, but you know, I'm looking forward to traveling. Like last year, I spent 70% of my time traveling the world, meeting with startups and investing in startups. This year, I have been stuck. You know, we're all stuck in our homes working because of this COVID-19 virus. So hopefully it will end soon and we can get back to normal. Let me do a screen share now with all of you.
Yeah, of course. This virus situation is everywhere, like crazy. And I just spoke with my friends in Brazil. It was tough. And in Russia, we just start slowly reopening our borders. It's crazy. And I was supposed to be in Silicon Valley already a couple of months ago, so I got stuck in here.
Yes, I was supposed to be a lot of places a couple months ago, and I haven't left. So let me figure out the screen share. Where is the screen sharing tab? It was here a minute ago. One moment, please.
Take your time, please. In the meantime, for the attendees on Zoom, please write your questions in Q&A section. And once Steve finishes, we will ask you questions using Q&A. So please go ahead and write your questions in there when you can.
Okay, I'm going to share the screen. Absolutely. Here we go. Okay, so I will start with Founder Space. You can see there's Chinese under this because I do a lot of talks in China, so I have it in both languages. And let me start with Founder Space itself. You see the blue dots. We have over 50 partners in 22 countries, so we work all around the world, which is why I travel so much. And really, we have our own incubators and accelerators that we run. But even more, we work with other incubators and accelerators. So we will send our instructors and our venture partners all over the world to actually collaborate with incubators and accelerators in various countries. And we work with the governments too. So we work with a lot of governments. I've actually Russian government officials in China place and not too distant future to be coming to Russia and forming a deeper collaboration. In addition, we work with many large corporations. So we have worked with Qualcomm, with Huawei, with Bosch, the big German company, and many, many others running innovation programs for their teams. So helping large corporations innovate in the same way that startups innovate. So we kind of, our business model for Founder Space has been multi-pronged. One, running our incubators and accelerators. Two, investing in startups. And three, working with large corporations. Founder Space has won a number of awards. Forbes ranked us the #1 accelerator in Silicon Valley for overseas startups. Entrepreneur Magazine also ranked us #1. And Inc. Magazine put us in the top 10 overall. I have 2 books. So the first book is all about innovation, and that is called Make Elephants Fly. And the elephant is your big idea, that dream you have that seems impossible to get off the ground because it's so big. How do you make an elephant fly? But the book shows you step by step how entrepreneurs around the world, and especially here in Silicon Valley, took their big ideas and made them go. My second book, which will be coming out soon from HarperCollins, the publisher, is called Surviving a Startup. It isn't on the store shelves yet, but it's coming. And it is all about how you, as an entrepreneur, struggle to survive and the different things you need to do to come out on top. So it's especially relevant right now because it's tough for a lot of startups with the virus situation around the world, with the economy suffering. It's very difficult. The book really shows you how different entrepreneurs tackle different problems in very difficult times. So let's start with the 10 commandments of venture capital. So I have raised a lot of money, as I mentioned earlier, and at the beginning, when I first started raising capital, I knew nothing about how to raise capital. So I really had to learn the hard way. And in fact, I didn't know any venture capitalists. So I'm going to show you step by step each thing I learned. So ~1, venture capitalists want elephants. So by an elephant, I mean a big idea, a company that can grow into a multi-billion-dollar company. So a lot of entrepreneurs have a good idea. It's a solid idea, but it's not going to be the next elephant or the next unicorn. It is going to be a medium-sized business or a small business. If this is the case, the majority of venture capitalists, especially the ones here in Silicon Valley, are not the right target for investors. You need to approach other investors because the model here in Silicon Valley is very specific. So first of all, a Silicon Valley investor, a lot of them have very large funds. You know, $100 million fund in Silicon Valley is considered small. So a lot of the funds are $500 million, $1 billion, even more. And for these funds to make a return, if let's say you have a small startup and you go to those investors and you say, look, if you put in $1 million, I can give you a 10x return, right? Because my company is going to grow, will probably become 20 million, and you'll get, for your 1 million, you'll get 10 million back. You know, the other shareholders will get the rest. It's a really good investment. It's almost guaranteed. Most venture capitalists, almost all of them in Silicon Valley, will say no. They will reject that offer, even though it's a 10x return. And you might ask why? Who wouldn't want to make $1 million turn into $10 million? Well, the thing is, if you look at the size of their funds, if you have a $500 million fund or a $1 billion fund, and your job is to put that money to work within usually a 3-year span of time. So in 3 years, they usually have to make all their investments. Then they wait another 7 years or so for the fund to mature and the investments to exit their investments and then distribute the money to their limited partners. That's how it works. $10 million is a rounding error on a $500 million fund. It will not move the dial. It will not make any difference in the profitability of their fund. It's such a small amount of money. This is why when you come to them and say, I can get you a 10x return on your 1 million investment, they will say no. They're not interested because they need to have an exit where they are making, hopefully, hundreds of millions of dollars. So that it can actually, when they show their investors, their fund itself can be returning a huge amount of money. And another thing you have to remember is that in a venture fund, not all the investments pay off. In fact, the math works out in a very specific way. So a few of their investments, a handful, 1, 2, or 3, will pay for the rest, all the losers. You know, the majority of their investments in any fund will either break even, they'll get their money back, or they'll lose money. The other half of the investments they may make some money, but it's usually one company, a single company in their portfolio that turns into the giant elephant. You know, the company that brings in the returns from that one company are more than all the other companies combined. So when a Silicon Valley investor is looking to put capital into a company, they want every company they invest in to be possibly the elephant. They know they all won't be the elephant, but they figure if they go elephant hunting, if they get enough potential elephants in their investment portfolio, one will pay off. And that is called a fund maker. So they don't invest in anything that they don't think can be a really big, oversized return. That's what they're looking for. So when you're pitching them, your vision has to be, look, this can be your fund maker. This can be your elephant. This can bring in enough money to pay for everything else and give a healthy return to your limited partners, which are your investors. Now, the other thing is when you're in Silicon Valley, you also have to understand that these funds, you know, the fund managers their time is limited. They don't have unlimited time to invest in startups. So most of the fund managers, they want, you know, the venture capitalists, they want to pick startups and put a lot of their time, their relationships, all of this into the company. They sit on the board of directors. They really make a difference in that, whether that company succeeds or fails. So if I'm a partner in a venture capital firm, I can only sit on so many boards. Really, what I'm worried about is less the money. I have plenty of money. In a big fund, you have a lot of money, but what you don't have a lot of is time. You have very little time. So I don't, again, want to waste my time on small or medium-sized investments. I want large investments because then I can put in, my very valuable time, I can dedicate to this company and it will pay off. There's a chance it will pay off in the long run. So even if I put a lot of time into a small company that doesn't have potential, I'm only going to get a small payoff for my time. Again, it's not worth it for them on many levels. And then you talk about other funds. Now, this is the big funds I'm talking about. What about those medium-sized funds, the small funds, the seed funds, the angel investors? Why don't they invest in smaller companies? Well, some of them do, but honestly, most of them are also looking for elephants. Why? Well, because most of the companies in Silicon Valley, if you don't grow very fast and very big, you usually don't get an exit. Nobody buys you. The big companies, like the big corporations, they are usually they value most companies that are growing very fast. Those are the ones that they'll acquire for a lot of money. Because again, if I'm a big corporation, if I'm a Microsoft, if I'm a Google, if I'm a Huawei, if I'm a big company, right? And I'm going to acquire something, it has to make a difference to my bottom line. If it's not growing fast, if it doesn't have huge potential, it's really not going to be a business that affects us, right? So again, it's a rounding error. So they'll ignore you. So it becomes very hard to exit a company that isn't on its path towards becoming a big business. A company that is a small business, you can't take it public. You can't find people to acquire it. Even a medium-sized company, you could take it public sometimes, but the market cap is low, the payoff is low. Most of the value lies in the few companies that are positioned to grow extremely rapidly and become multi-billion-dollar businesses. So the smaller investors, even if you're an angel investor in Silicon Valley, you're saying, I don't want to waste my time. I'll probably never get my money out of the company. That company I'll just be giving the founder some money, and then they'll go along with a small, slow growth business or a medium-sized slow growth business, and it'll be decades, if ever, before I get my money back. They don't want that. Most investors want a return within 10 years. They want to get their money back within 10 years. The minute they give you their money, they want it back. So for this specific reason, the small investors, just like the big investors, are looking for companies that will grow really fast. They've also found that the small investors have found that if they put money not into an elephant, into a smaller company, then that company has trouble getting follow-on investment, because if it's growing slowly, none of the other investors will give it money because they are also looking for elephants. So it becomes a whole ecosystem built around elephants. Everybody wants big returns. And if you come to Silicon Valley, you have to be prepared for that. So they're really not looking for traditional businesses. They're not looking for solid, slow growth businesses. They are looking for businesses that grow exponentially, the new tech businesses. And that's why technology is so key here. When you're pitching your startup to investors, one thing I always tell entrepreneurs is don't talk just about what you're doing today. Yes, it's good to show investors what you're doing now. That's very important. They need to understand what you have. But you have to remember that what they're investing in is not your company today. They're investing in what you will become 3 years from now, 5 years from now, 10 years from now. That's what they're investing in. They're investing in the future. So a big mistake entrepreneurs make is they spend too much time focused on their business and all the details right now. You should spend some time showing them what you have, but everything you show them should point towards the future. What does this mean? What am I doing now that will pay off in a big way in the future? And make it real for them. Like actually make it visual. If you have a product that is a prototype, show them the next generation version. Even if you haven't built it, have somebody model it in 3D or an artist sketch it. Whatever way you need, make it come alive. And show them the product 5 years from now. What will the product be 5 years from now? How will it evolve? Have you even thought about that? Where are you going? You need to paint this picture of the future. And the best way to do this is with visuals. Use video, use 3D modeling. And if you can bring in a physical prototype, something actually physical to show them, that you built, like if it's a product you're selling or whatever, and they can put their hands on it, really, really valuable. Showing them that makes it tangible and allows them to believe in your vision, in your future. And remember, that's what they're investing in. Know your valuation. So a lot of startups come to Silicon Valley. I work with them from all over the world, and startups here who are American startups. I work with them. And they actually, often they come here, they have no idea what their company is worth. You know, what is my startup worth? How much should I value it at for investors? And the problem is, if you value it too high, if you pick a number that's too high, you say my company's worth $20 million, and it's not, no investors will respond. You'll get nothing. And if you value it too low, then you're giving away a lot of your company for free, which isn't a good idea. You really want to figure out the right valuation. So how do you do this? How do you figure out what your company is worth when you have no revenue, when you're just beginning out, or your revenue is very small? How do you know what this company is worth? Well, let me tell you, every ecosystem like Silicon Valley is a marketplace. So it's really like the stock market. There's a supply and a demand, and that determines the value of the company. Only unlike public markets, publicly traded stock, this is a private market. And that means that the exchange, people aren't trading your shares. So it's much, much more similar to actually a housing market. In housing, it's a private market. You have a house. How do you know what it's worth? How do you know what your home is worth? Well, you look at the homes in the neighborhood. What is the home down the street that sold for? How much did it sell for? How is that? Your neighbor's house? What did it sell for? These are data points. So when you come to Silicon Valley, the first thing you need to do is look at similar startups. What are other startups getting funded at? What is their valuation? Now, how do you find this out? Well, there are a couple ways to find it out. One, if Silicon Valley in normal times is a networking paradise, like everywhere you go, every night, there are entrepreneur events and entrepreneurs are getting together. You can just go out there and start talking to entrepreneurs and figure out how they're valuing their companies. Also, you can meet people in the profession, and they don't have to be venture capitalists. Venture capitalists are great because venture capitalists really see a lot of startups, and they have a gut sense for the value of each startup because they're looking at so many deals. So they're looking at all these deals closing, just like a real estate agent. Real estate agent, you ask the real estate what your house is worth, and the real estate agent knows. The venture capitalist will know. So what you don't want to do is ask a venture capitalist that is thinking of investing in your company, because they will tell you a lower valuation or nothing. They'll want you to tell them because you may pick a number that's lower than in their head. What you want to ask is venture capitalists who aren't investing in your company, people you meet who can just be an advisor, who can just give you advice. You can also go to lawyers. Lawyers are working on these deals. They see the numbers. They can give you a very good idea. There are many professionals in the industry who actually have a really good insight into valuation. You can also go on a website like Angel Co. It's called AngelList, angel.co. It's a marketplace for early stage startups where they're putting, and you probably have heard of it, where they're putting up their companies and they're getting funding from angel investors. Now, if you're registered as an angel investor on the site, you can look at the valuations of all these startups and you can get a really good idea for the market. So if you can sign up as an angel investor, you can see the valuations of all these startups. If you aren't able to do that because you don't have the resources, you don't qualify as an angel investor, they ask for proof, then you need to find an angel investor who has access and go with them in their account and start looking at the valuation. It can give you a really good sense. Now, valuations are interesting because the valuation of your company in Silicon Valley will be very different than the valuation of your company in Moscow or Beijing or New York. Every city is its own ecosystem. Every city has different valuations depending on supply and demand and the potential of the market, right? How big can this company become in this market? How much money is there available? How much risk will they take? And all of these things come into the equation. So your same company, it won't be the same value you have in Russia. It'll be a very different value in Silicon Valley. And if you go to Beijing or Shanghai or any other place in the world, your company will be worth a different amount. You need to figure out the amount for each country. You can't just assume what your company is worth, that is worth the same. Now, one thing I want to tell you is I had a startup who was, it was a brilliant startup. The founder was amazing. He was the type of founder that I love. He, you know, he built this company. He had his prototype. He made this incredible video showing the potential of his company. Everyone who saw his video wanted to invest. And he came to me and said, you know, I think my company is worth $20 million. And I told him, no, it's not worth $20 million. I guarantee you that's too much. You know, your company at the stage you're at, you should probably value it around $5 to $10 million. So less than half of what you say. He didn't want to listen. So I said, look, I love what you're doing. I'm going to introduce you to a couple investors and see what they say. You don't have to trust me. I'm just giving you my gut feeling on your valuation. He goes to these investors. They're super interested. But when they hear the valuation, they back out of the deal. So I'm like, okay, lower your valuation. You know, you can get investment if you lower it. He refused. He was very stubborn. So he refused. For the next year, he tried to raise money. And you know what? He couldn't raise it because his valuation was too high. He was just wasting his time. And meanwhile, other companies, I saw other companies entering the marketplace with similar ideas. And I was like, what are you doing? A year and a half later, I met him again, and he told me he had just closed funding. And guess what? The valuation was, you know, just around $5 million, just around what I told him it was. You know, I can't say strongly enough, time is money. You know, you could wait to try to get a higher valuation, but honestly, you are killing your chance for succeeding, because really good startups in Silicon Valley move fast. The deal moves fast, and competitors are moving fast. And if you're wasting time, you're going to fall behind. It's a race. You know, starting a company in Silicon Valley is a race. So don't waste time over your valuation. Figure it out. Don't try to get the highest valuation. That's not going to serve you well. Don't get the lowest valuation. Get a medium valuation, and then be selective on your investors. You know, the investors who invest is far more important than the value you get in the long run, because those investors create value. And really, a great company is all about value creation. Remember that when you are going out for funding. Know your competition. So I meet entrepreneurs all the time, and one of the first questions I ask is, who's your competition? And every investor, every smart investor will ask this, because you need to understand why this company is different. What's better about them? So I get entrepreneurs who will tell me, I have no competition. And honestly, this is a very bad answer. First of all, it doesn't give me the tools I need to evaluate your company, right? I can't tell what's good about, if you have no competition, it means one of two things, right? Either you're one in a million company who has come out with this product that nobody else has ever thought of, and there's nobody working on, and there's no similar thing already in the marketplace that does the same thing. Yours might be better, but it's filling that need. Or that your business is a dud, right? If you have no competition, most likely it means that people have tried your model and it doesn't work. They failed. So there aren't competitors around, because it's not a viable business. If your business is real, usually if your business is real, people are using something out there. You have some competitor. It doesn't have to be a technology company. It doesn't have to be a startup. People could be using pen and paper could be your competition. They could be doing it manually, and you're coming in with this new technology. So you have to show, or it could be an old service, a traditional business, and you have to show, well, why is my new way of doing things, my technology, my business model, why is it superior to how people are doing this now? What value do I create that they can't create? How can I lower costs and disrupt an industry? What are my advantages? I need to see this. And the only way I can see it and really understand it is through your competition. So spend a lot of time knowing your competition. Figure out what people are using today to do what you're offering. So if you're offering a service like, food service, right? Delivering food, how are people doing it today? And what do you have that's superior for doing it tomorrow? Are you going to do it all with robots? Or, what is it that you're going to do that will bring down the cost, raise the quality, give you barriers to push out those competitors. Also, I can usually judge whether an entrepreneur is really good based on how much research they've done. Too many entrepreneurs get enamored with their idea. Like they come up with an idea and they fall in love with it. Like, this is the best idea ever. And they just dive into building it. Like, I've done that. When I was first starting, I was like, this is the greatest idea. And I just started building it because, I wanted to create that company. I love that idea. But honestly, before you ever start building anything, what you need to do is a lot of research. I want, like, when you come up with your idea, I want you to not build a single thing, not write a line of code, not build a prototype, not do anything. I want you to spend like a month, an entire month researching the market. Like, who are the competitors? How are they doing stuff? What are they doing? Like, use their products. My God, have you used your competitors' products? Do you know them inside and out? Because only if you know them inside and out can you build something far superior. You have to know everything they did. And first of all, if they're doing things right, if they are really smart, you should take those ideas and use them. But then you have to figure out something that they aren't doing, some value in the marketplace that you can offer that none of these other people offer. Because honestly, why would anybody go to a startup? Why would anybody change the way they're doing stuff if you can't demonstrate to them that you're going to give them more value? And it can't be a little more value. It has to be a lot. It has to be a lot more value. That is the key to building a great business. And that is the key to getting investors, knowing your competition, understanding it. Investors need data. It's not enough for you to say, I have a great idea, right? And this is brilliant and, wow, dazzle them. Well, some people, when they're really good salesmen, they can get away with it. But most smart investors, they will want to see the numbers. And by this, I mean, they'll want to see, you're saying this is true, but how do I know it's true? Like, how do I know this is true? Prove it to me. So even at an early stage, you can get data, even before your product launches. Now, this is key because a lot of entrepreneurs say, I can't get data. I haven't launched. I don't even have revenue. I don't have customers. How do I do this? Well, let me give you just a few ideas. Number one, you can get a video camera. And if, let's say you're selling to businesses, selling to companies, but you don't have your product yet, but you have your pitch, you have a presentation, you have a prototype, something you can show them. You go into these potential customers and you pitch them, and then you ask them if you can make a really short video of what they think. Then what you do is string together like clips. The clips can be 10 seconds, 15 seconds of all these different customers telling the camera why they need your product, what it does that none of the other products out there, and why they're so excited for you to bring this to market. And then you show this to investors. Wow, that simple video can wow an investor. They're like, oh, all these people really, in their own voice, they're telling me. It's not you telling me what they think, they're telling me. This is key. That is data. Another way to get data is put up a website, right? Put up a website before your product launches. It could be a hidden website. Like if you go to crowdfunding sites like Kickstarter, Indiegogo, those are fine, right? But you should go to those later. If you put your idea up on them too early, I mean, the world sees it, right? So people can copy it and just run with it. If you want to keep your idea hidden longer, but you still need to get this data from customers, put up a website. It's a private site. Nobody knows about it. And then target your customers directly. They can be consumers. They could be businesses. Putting up ads on Facebook, very targeted ads on Facebook and Google. Drive that traffic into the website. On the website, you can have a video that shows your product. You can have pictures of your product. You can have whatever you want showing and explaining your product. And then on that website, put a buy button. And what you're measuring is how many people click buy. So how many people click buy or contact us, right? So you have these two buttons prominently there, and you are getting analytics on this. And the ones who click, when they click buy, you tell them the product is coming soon, enter your email address, we'll notify you when it's ready. And basically, so you're not deceiving them, but you are measuring that they are actually interested in buying the product. And you can even test out different price points. And you come in right below the buy button, buy the product at this amount. You can come into investors or just download it. If it's a free product, just have a download button. This data, the percentage of users when you're targeting them that actually respond to what you have in a way that they want it, they want to try it, they want to use it, is really valuable data. So as an investor, that's what I want to see. If you get far enough along, you could even put up an alpha site or a beta site and start measuring what early users are doing in your app. How long are they staying? What features are they using? All of this data makes a huge difference. So when I'm going to invest, I see so many apps. It's hard for me to know which are going to be successful. Like, I can try them out and have my own gut instinct, but I also want some confirmation, because I'm just I'm just one data point. So I want to see how are other people reacting to this. You need to give your investors that insight. Those are the companies that get funded. They get funded fast. So if you have real data that you can extrapolate from that data, wow, this thing, when we put it out there, it's going to grow like crazy, investors will give you money. They will give you money. At the beginning, when you're coming to Silicon Valley, a really important thing is seek advice, not money. So too many people are focused on closing the deal right away, getting money. But honestly, the advice you get, the relationships you make can be far more important in the long run. So when you go out there, instead of just trying to sell people, so I meet a lot, as an investor, I meet a lot of entrepreneurs, and they immediately just try to sell me on their company. They're like, bam, 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 this is why you should, buy, invest in this company, buy my shares. They're pushing their shares and they're trying to get me to say yes. Well, if you've ever walked into a store and the salesperson is really pushing to sell you something, how do you feel? You usually feel like, give me some breathing room. I don't, you're too aggressive. I don't want to buy, I don't even know your company yet. How do I know if I want to buy it? So when you go into investors, instead of focusing on closing the sale, you should focus on two things. Number one, explaining to them what your company does so that they can really understand it. And then number two, asking for their feedback. What do you think of this? What are your ideas? If it's not in an investor pitch, a very important thing to remember is it's not how much you talk. It's not how much you say that matters. It's what's happening in your investor's head that matters. What's happening in their head? You want to get them engaged. You want to get them interested in your product. You want them to be thinking deeply about it and get excited about it. People get excited about something that they put themselves into. You put a lot of yourself into this company, so you're very excited about it. The investor hasn't invested anything. No time, no money, nothing. So they're not, why should they be excited? They're kind of, show me, make me excited. A great way to get investors excited is to ask their opinion. When we give an opinion, when we start to think about the potential of something, and we come up with if you let the investors come up with their own ideas around your product, all of a sudden they're investing themselves. They're investing themselves and into your company, and it's their idea. And people get very excited about their own ideas, much more excited than they do about other people's ideas. So get the investor talking, get the investor thinking, make the investor your partner. So when you go into pitch an investor, don't pitch the investor to get their money. Pitch the investor to get them interested, to get them on as your partner. And as an investor, I will tell you, I know all the investors here, we love entrepreneurs that we can collaborate with. Because, we're not going to be on the board of that many companies. If we're going to put a lot of money into this company and put a lot of time, we want it to be a real collaboration, a real working experience. We want to feel like it's our company too. This is how investors feel. So let them feel that when you're pitching them. It also gives you a chance to know them. Do you communicate well? Do you like their ideas? If you don't like their ideas, if you don't like how they interact with you, it's not going to be a good fit anyway. You shouldn't take their money. And they get a feel for you. They get to start to know you. So in your mind, when you go to pitch investors, be out there seeking their advice, their ideas, their feedback, their engagement, not their money. The money will come. I will tell you, if somebody is interested, if they like your company, if they like you, and that, you don't have to convince them to invest. They will convince themselves that they want to invest in this company. You don't need to sell them. So don't sell investors. Don't pitch them. Don't go through your PowerPoint. Just talk, 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 and never give them a chance to talk. Make it a two-way conversation. Two-way. The best pitches ever are where they're talking more than you're talking. They're asking more questions than you're having time to give answers. That's when you know an investor pitch is going really well. Make it memorable. So when you go into pitch, you get one shot, right? They don't usually, if they don't like it, you're out. Investors see hundreds of deals, the really good ones, a year, and they're just like looking to say no. So, and they're bored. A lot of times it's like they've seen so many similar pitches. They're bored. So how, when you go in to pitch them, can you make it something that they are like, oh my God, this is just absolutely amazing. This is mind-blowing. And they don't forget you. One way, let me give you a couple examples. So I was at this investor pitch. It was an open pitch night, lots of companies pitching. Each company gets 10 minutes. So a very short amount of time, but 10 minutes, to pitch their company. Well, there's companies are coming pitching. Most of them, honestly, at the end of the pitch night, you don't even remember most of them. Like you've forgotten, like you may remember 1 or 2 out of 20, that actually stick in your brain a week later. So all these companies are pitching, and one company comes up there, and the entrepreneur goes up and goes, see this? This is my product. He holds up a little tiny device, and then he goes, you stick it behind your ear, right behind your ear like that. Once you do this, it will change your life forever. And then what this investor does is he goes, I am going to demo this at the back of the room after the pitches are done. If you want to try it out, come to my table. And he walks off stage. His whole pitch was 30 seconds out of 10. He didn't take 10 minutes like all the other entrepreneurs. He took 30 seconds. After the pitching was done, everyone was at his table. Everybody flocked it. They were competing to try it out. He, this sort of thing, he did something different. Made it memorable. He did something that he stood out from the crowd, right? He did something none of the other people pitching does. Now you can't do this over and over, this little trick he did, but it worked this one time. Now, when you get up there, I always tell entrepreneurs, show them something. Like if you have a robot, bring the robot on stage. Have the robot do stuff, right? They don't just talk about the robot. Nobody wants to see a PowerPoint and you talking about the robot. They want to see the robot. If you can't bring the robot on stage because it's too big or whatever, make a video, show the video, make that robot come to life. I've been to pitches where they're food startups, and they're pitching that they're saying, we have this incredible food that we've developed with this new technology and it's incredibly flavorful and healthy. And then I'm like, can I try it? And they didn't bring the food. Like if you're going to pitch and you have something that you can give investors, use that they can smell, they can taste, they can touch. Let them smell, taste, and touch it. Let them remember you. Let them try your product. I had a virtual reality startup come to me, and this was in the very early days of virtual reality. They're now one of the top virtual reality content companies out there. And they actually showed me their unit, and I tried it. It blew my mind. It was the first time I ever tried virtual reality. It was the days, when Oculus wasn't even out. They had their basically construct their own unit to show their software, and it was just so amazing. They're like, now help us with our business plan, and I'm like, forget your business plan. Your business plan doesn't matter. Don't waste time. I don't even want you to show a PowerPoint when you go into investors. Just put this device on them, and I guarantee we can get you funded in a couple months. No doubt, in a couple months we'll get funded. So we go out there and introduce them to a few investors. 2 weeks later, they had closed $5 million in funding. They went from 0 to 5 million on a prototype because they made it real. They made it memorable. They had the investors try their thing. They had them try the experience. This is what you want to do when you pitch. Create competition. So when you're pitching, if you want to get a decent valuation, a higher than average valuation, and you want to close, and more importantly, you just want to close a deal, you want to get the investors to commit, the most important way to do this is to create competition. Basically, have your investors compete against each other. And honestly, I'm an investor and I pitched my own startups. So I've been an entrepreneur at pitching. Investors won't invest until they feel there's some pressure to do so. Now, I will tell you, when investors move fast, usually it's because they're afraid that somebody else is going to take the deal away from them. If they feel like they can wait and watch this company and get a better idea of how good it is, usually they'll say, wait, they'll say, come back in 6 months, come back in 3 months. We'll look at you then, see what progress you've made. They say this all the time. Now, I got that response over and over and over in Silicon Valley. They're like, oh, this is really interesting. Come back in 3 months, show us what progress you've made. It was killing me because I couldn't get investors to commit. They would not commit. Even though they liked what I was doing, they were willing to wait. Let me give you an analogy. Let's go back to real estate. If you walk into a home and you think, wow, that's a really nice home. I could live here. This is a nice home. And the price is decent. And then the real estate agent says, oh, don't worry. You can go look at other houses. This will be around. This will be around a month from now. You just go look and find what you think. Then you'll go, sure, I'll go look at the other houses, see if there's a better deal or something I like more. But if the real estate agent goes, this is a hot property. This is going fast. You don't put an offer on this like tonight, it's probably going to be gone a week from now. Then you're much more likely to make an offer on that house. It's the same with your startup. If the investor feels like you're not going to be around a week or two from now, they're going to be much more motivated to push that deal through quickly. So my very first startup, I spent a year trying to raise capital, a year talking to investors. I didn't know what I was doing. They kept putting me off. They kept, sitting, what we call sitting on the fence. They wouldn't make a decision. They liked my company. They didn't know. They would do this, do that, come back with more data. We want to see when your prototype launches, all these different things. Finally, I figured it out. I was like, I have to create a sense of competition. So sometimes you don't actually have anybody else who's making you an offer, right? There's nobody else out there. There's no other investor who's actually said, I'm going to offer you, give you money for your company. You don't have any offers on the table. How can you tell them you have competition when you don't have any solid offers? Well, there is a way. And so this is what I did. Like, I walked in to one of the top VC firms in Silicon Valley, and with me, I brought along one of my strategic partners, which was Adobe. It was, at the earlier time, it was a company called Macromedia, which morphed into Adobe. The president came with me. I brought the president because he made the introduction to the VC, and I said, come along. And so he's sitting there. That's validating my business, right? I pitch my company. And then the investor's just sitting, listening, no reaction, right? And at the end of my pitch, I said, and I point to the president of Adobe at the time, Macromedia, and I say, he's going to take me around. You're the first investor we're talking to. That's all I said. You're the first investor we're talking to. We're going to go out and talk to some other investors after this. And he said, oh, well, can you wait a second? And he disappeared. I was like, oh, that's strange. And then he comes back like 5 minutes later, and he goes, here's the term sheet. We want to close the deal right now. Like, that's it. The first meeting, like one pitch, and he's offering me $7 million in investment. Why? Because he felt if I walked out of that room, somebody else was going to do it. It was that simple. Now, I didn't tell him I had other investors. I never lie. Like that. Don't do that. It will ruin your credibility. And honestly, people find out about these lies because look, if you say somebody else is going to close the deal next week and then you're still out raising capital next week, the word will get back to that investor and they'll go, what a liar. You can't trust anything that person says. Do not lie, but you can tell them the reality. So in reality, you need to create what we call an investor pipeline. You need to be talking to multiple investors at once. And when you're talking to investors, you don't want to do it in a blatant way, but you let them know that other people, you're talking to other people. They're interested in your company. And if they sit around, you're not coming back. Literally, you can meet with an investor, but you're not going to keep coming back to them over and over and over because there are other people who are interested and the deal will go away. So you have to create this sense of competition. And then it's much easier to close a deal. Fear and greed. That is what motivates investors. So if you really want to get into the psychology of this, which I have analyzed it very deeply from both sides of the table. People are motivated in the investment world by fear and greed. So the greed is the part, these investments aren't just about money, right? It's not just about making money. It's about their greed for their reputation. These investors care about their reputation. They want to be the one who discovered the next Twitter, the next Facebook, when they were just, a startup and nobody knew about them. They're a tiny company. They want to put their name on that. That's their goal. They want to bring in a great deal to their venture firm. They want to be the one that shows their venture firm, the fund maker that makes the firm, because that's how they move up in the world. Now, you have to understand they also have fears, not just fears of losing their money, not just fears of losing the deal, but their greatest fear is that they will be embarrassed in front of their peers. That's how people are, right? So investors are the same way. It's a very tight-knit community. All the investors here in Silicon Valley know each other. They all know each other's deals. And they're afraid that they might present a deal to their partners, that their partners are like, why did you bring us this? This is the worst deal ever. And then they stop trusting them, right? No investor wants to look bad. Their reputation is more important than anything else they have. So in order to close a deal, you have to have their greed. It's like a scale, right? The greed needs to be greater than the fear. That's when deals close. If their fear is greater than their greed, it never closes. They're just too afraid. And investors are afraid of a lot of things. They're afraid of losing the money. They're afraid of losing their reputation. They're afraid of all these, what their partners think of them. All these different things are going through their head. You have to balance these out. So you have to show them, that they can, it's a huge company. They can make a lot of money. They can make their career. The risk is very low, right? The risk is very low. They don't act, they're going to lose the deal. That gets those things, one assuages their fear, other get their fear up that they have to move. All these things are coming into play. Now, I worked inside a venture firm, one of the top firms in Silicon Valley, incubated one of my early startups. So I was in this firm on Sand Hill Road, which is the road where all the big VCs are. And, every day the investors would be coming to me, showing me deals, showing me what they had, asking my opinion. They're always going around and asking opinions, and especially since we were a startup, literally working out of their venture office and their extra offices, the partners were continually coming. The one thing I learned is that the senior partners, the more senior the partner, often the less likely they are to push hard for your deal to close. So in a venture firm, in a typical Silicon Valley venture firm, you need what's called a consensus. You need basically all the investors in the firm, and usually it's 10 partners, to agree. If one partner says, no, this is a bad deal, most firms will back out of the deal because they know that there are plenty of other deals they can have. So they want everybody to agree. Why do they do this? So that none of the partners can say, I told you so. I said that was a bad deal and you guys went ahead and you lost a lot of money. That's what they don't want. They're afraid of that, right? So by getting consensus, getting everybody to say, I think it's a good deal, then nobody can say, I told you so. That's the goal. So that's how they operate, honestly. I know on the inside, that's how they work. So you need to get all the partners to say yes. That's the first thing, right? But in order to get all the partners to say yes, it's not, you don't know all of them. You pitch to one or two partners at the beginning. And if they like you, they take you in front of all the other partners who you've never met. And you have to pitch to the whole room. Now, what matters is what goes on before you pitch them and what goes on after you pitch them. Who is lobbying for your company? Who is pushing this? Who really are they priming the other members? Are they giving them information? Are they getting them excited? You need a champion inside the venture firm. And often it's not a senior partner. You know why? Because a senior partner is afraid of being embarrassed. They're afraid, their reputation is on the line. If this company is a success, fine, everybody takes credit. Like if it's a success, all the partners say, yeah, we approved the deal. If it's a failure, they always blame the person who brought it in, right? So nobody wants to be responsible for a failure. So often the best people to get to back your company, to push it through, are the junior associates. They're not even a partner in the company. They're associate. They're usually somebody who graduated an Ivy League school, Harvard, or they graduated from MIT or some other top school. They've been invited in, kind of like an intern, but they get paid decently, and they help evaluate deals. Well, the associates have nothing to lose, and they don't know the system. They're new to the system, so they don't understand exactly how it works. So often they are the ones who will take the huge risk. And the senior partners will often push the risk down to the associate. They'll say, look, this associate, I want you to do all the research. They tell their associate, and you come back and tell us if it's good. So the associate is the one championing your deal. You have to remember, the time you spend with the junior people in the company, the associates who are looking at your deal, is often the most important time you can spend. If you can get them on board, the other people will often come on board because they're going out and selling them. And that's where a lot of entrepreneurs don't get it. They think, I have to talk to the managing director. That's going to close the deal. Or I have to talk to senior partners. No, sometimes it's the associates who will do more to close your deal than anybody else, because they want to make their reputation. They want to bring in the big company, and they aren't afraid. They're young. They aren't invested in the system. They're willing to take risks. Kissing frogs. This is my last slide. And I want to talk about my rule for investment. When you are going out to to pitch investors, I always say investors, venture capitalists, are like frogs, like this little frog here. You kiss the frog, hoping that frog will magically transform into your Prince Charming and carry you away, right? And make all your dreams come true. That's your wish as an entrepreneur. I kiss this frog and boom, they're my Prince Charming. Well, I will tell you, only kiss a frog 3 times. If you've kissed the same frog 3 times and that frog hasn't turned into Prince Charming, it's just a frog. So every investor, by kissing, I mean, you go and the first time you present your company to the investor is your first kiss. Now, probably they won't turn into Prince Charming, right? No, happened to me that one time, where they gave me the term sheet on the first meeting, but more often than not, they have to go through a process. So you basically, you show them once, you get them excited, and then there's a follow-up meeting. Follow-up meeting might be with a second venture partner. Now, in that second meeting, you have to let them know at this point in time, not the first meeting, but the second meeting, that you are willing to give them everything they need to know in that meeting, everything they need to know to make a decision. Either they have to move the process forward or you are moving on. So basically, either they have to bring it to a partner meeting where they make a decision, or a third meeting, the third kiss, or you are going to move on. And if you don't let them know this, a lot of times they'll just keep you waiting. They'll keep you waiting for months and months and months because they don't want to say no. Your company's very interesting, but they haven't been convinced to say yes. And there's no reason they have to. You haven't put the deadline down. So you have to create this artificial deadline. Now, on the third kiss, on the third time you're meeting them, and remember, this is a rule of thumb. That means it's not always the same. Like sometimes it's 5 kisses, sometimes it's 1 kiss, like I told you. But honestly, after a first few meetings, your chance of closing a deal reaches its peak. Honestly, it reaches its maximum. If you've met with an investor 3 or 4 times, that's the time to close the deal. If you don't close the deal, then all of a sudden, your chance of ever closing that deal starts to drop exponentially. So it goes up exponentially from the first meeting, it goes up, peaks, and goes down exponentially. The idea is close them in like the 3rd or 4th meeting, maybe the 5th, but beyond that, if you're still talking to that investor, the chance of them ever closing goes down and down and down until it's almost nothing. In other words, you are wasting your time. So cutting off an investor, telling an investor, I can't come back and talk to you again. I'm not going to come back in 3 months, right? I'm not going to, whatever it is, you have to make a decision now is really important because you need to know if this frog is going to turn into your Prince Charming. And it's better to know it right away so you don't have to waste more time because that time you could be putting into other investors than keep kissing the same frog over and over and over. Now, it wasn't my last slide. Okay, I have a couple more. Now, that was the last of the 10 commandments. But my what I'd like to say in wrapping this up is careful what you wish for. You know, getting venture funding is great. Like we see the results, right? These companies can become amazing, but it isn't the only path. I have run bootstrap companies too. And for some of you, your business might not, like I said at the beginning, be right for venture capital. It may be a much better business as a bootstrapped business. So you need to figure this out early. And you also need to understand that when you get venture capital in your company, you're on a certain path. You're on the path to become that elephant. And they're going to be pushing and pushing and pushing you. And if your goals aren't aligned with your investors' goals, if you want to keep control of your company, you want to keep it small, you don't want to, you know, it's not in you to grow this big company. You don't want to bring the investors in as partners. You don't want to really make them your partners. You want to run everything yourself. Then don't go down that path. Don't. Like, you will be sorry. Not every business and not every entrepreneur is suited for venture capital. So sometimes your dream turns out to be a nightmare if you either pick the wrong investors or go down a path that's wrong for you. Now, I will wrap it up by telling you, if you liked the talk today, you can come to Founderspace. So founderspace.com, just go there. You can contact us. There's a contact page on there. We also have lots of videos for you. There's free videos. And then we also have 2 online programs, like online programs. So if you like the talk here, I give many, many, many talks on marketing and on all the different things you need to know to run a startup as part of these online programs. They're like super rich, and they're very, very inexpensive. So they're not, you know, anybody can afford them. We made them very accessible. So you can go there and do that. And we love startups. So if you're coming to Silicon Valley, we have a place where you can apply for our incubators and accelerators, a place where you can apply for our fund. The same if you're entering China. So we are really gateways to Silicon Valley and China. We work all around the world with entrepreneurs, but we help these entrepreneurs a lot of times come into these markets, because those are the 2 biggest markets in the world where there's the most capital and where we have the most relationships. So thank you very much. I will stop sharing my slides and I will go and answer your questions. And like I said before, you can ask me questions about anything. I'll do this, I have to go at 11:30. I talked a little long, so 11:30 my time. So we have 20 minutes for Q&A, 20 minutes for Q&A, and you can ask me about China, you can ask me about Silicon Valley, whatever you want to know.
So it was amazing. Thank you so much for your talk. And just quick note, please share with me privately or your contact details, or you can do it here as well in the chat. So I will post it in our community so more entrepreneurs can reach out to Founderspace and to see other videos you have. So just feel free to do this. I'll be happy to spread the voice about Founderspace and
My
your
pleasure.
books. First question is from Supermotoric. Can you narrow down the Chinese ecosystem and cultural difference in comparison of US or Europe? How we can believe Chinese partners? They are famous for stealing the technologies.
Yes, so those are good questions. So I do a lot of business there. I had to learn the hard way myself. And I help a lot of entrepreneurs look out for their interests in China. So one thing you need to know is that China is not like the Western countries, in the sense it's a very Asian country, a very ancient culture, and their culture is a relationship-based culture. So when you enter the China market as a foreigner, you are at a severe disadvantage because, first of all, you don't have any relationships. And all of business in China, they call it the dinner table culture. It's around the dinner table. They are having these big dinners and they're constantly, it's like every night. Like business people in China are literally like, they don't see their families. They are like out every night meeting government officials, meeting business partners, meeting, investors. Every night they are networking around the dinner table. They are building relationships. And the mistake foreigners make is, first of all, the most important thing is if you get a Chinese partner, trust, you have to be able to trust them. Now, I will tell you, some Chinese you can't trust, but you can't trust some Russians, you can't trust some Americans. You know, there are bad people everywhere that you cannot trust. You have to be careful, especially when entering a culture where you're not attuned to picking up the signals of who you can trust and not. Like in Russia, you probably have a pretty good idea when you meet somebody whether you can trust them or not, because you've lived there your whole life. You go to China, it's so different. Like, how do you know, like, who's trustworthy and who's not? Well, you have to find people you do trust, and they might not be Chinese, but people you do trust who have spent a lot of time in China and have built relationships. They have the relationships. And through those people, they introduce you to other people, and together you form joint relationships. Now, China, a lot of foreigners think it's a one-on-one thing. Like, if I trust you, I can know that the deal goes through. Well, it doesn't work that way in China. One-on-one trust is not something that really works. It works with some individuals, but for the majority of business deals out there, if it's one-on-one and I'm doing a business deal with you and I'm Chinese, look, I'm going to be trustworthy to you as long as it's in my interest. As soon as I can get away with something that I think is better for me not to do, I'll just do it, and regardless of whether it's good for you or not. That's how a lot of entrepreneurs in China think. But what they do value is these networks of relationships. So like if you are connected to my friends and government officials that I know, and my family, and there's this big network of people that you are intertwined with, well, then our trust relationship is extremely solid. Like, it won't be broken, because if I break that relationship with you, then I am damaging my relationship with all these other people in my network. So this is the problem that foreigners make. It's not a one-on-one trust. It's yourself inserting yourself into the network and building multiple relationships with that person. So it's not enough to know them. You have to know their family. You have to know their business partners. You have to know their relatives. The more people you know, the more embedded you are, the more you can trust them, because there's no way they're going to break that relationship, even if it's to their advantage to break it, because it will actually, it's not to their advantage, because you have this big network of trust. So in China, you will see business people spend an inordinate amount of time building these networks, because these networks are trust networks, right? They're trust networks, and they're building these networks to build those relationships of trust, to get deals done. And Chinese investors will tell you, I will always invest somebody I trust in over a better business deal, right? They will always take somebody basically who's in their network, and Chinese will spend a lot of time. They form these groups, these business societies. There are so many business societies in China. Like, there are women's business societies, every college, from who they knew in college. They form these really close societies where everybody knows everybody. And they do business in these trust groups, these groups where everybody knows everybody. Everybody's relationship matters within the context of this group. If they're doing a deal outside the group, they might not be so trustworthy. But if they're doing a deal inside the group with members of the group, they are super trustworthy. They do not want to jeopardize that. This is what you have to understand when doing a business in China. If you can develop those type of relationships, you can be very successful there. And that is the key. You can really, I've seen foreigners do incredibly well, but it takes time. You have to invest in it. You have to invest in those relationships, and you have to know the right people.
Thank you. Thank you, Steve. Another question from Armani Magam. And by the way, I just wanted to let you know that a couple of hundreds people already watching us. And there are people from not only Russia, but also CIS countries, from Africa, and many locations. So Armani is asking, hi, thank you for the lecture. How important is it to know Chinese for fundraising? Can you state that if one knows Chinese, they have more chances to raise capital? You already touched on this. Do you think it's
so learn Chinese? Yes. If you knowing Chinese is great. Chinese people love it. Honestly, I haven't learned Chinese. I've been too busy, and it's hard. Like, you have to study Chinese, and I'm just not naturally gifted at languages. I'm gifted I have my other things, but I'm weak at languages, and it's boring for me to memorize a lot of words. China takes a lot of work. You have to memorize a lot of words. It's not an easy language to learn, but if you learn it, it's extremely valuable.
Thank you. And we have one person, Slava Gusev, is asking a question verbally. Slava, please feel free to talk.
Okay.
What is your... Hello?
Okay, do you hear me?
Yes.
Okay, Steve, thanks for a great webinar. My question is, now I am creating a website for networking at online events. Imagine yourself that now Daniel is dropping the link into the Zoom chat, and everyone who clicks on the link gets into the web page with table where contacts of everyone who is on this webinar. And my question is, what are your first thoughts about this idea?
Oh, to create a place where everybody can connect with everybody else?
Yeah, and the most important is that you can, in this table, you can find people who can help you to solve problems automatically using AI. You write your response, and AI find a person who can help.
If it really works, that could be valuable. Now, sometimes it's hard. People like me, for instance, I'm very busy, right? So I am probably not going to respond much because I am, it's really hard for me. Like I usually, when people contact me, I have to have my team members respond to them because I just can't look at all the business plans coming in. We get like thousands. So they'll screen them out, and I will selectively look at the ones that are recommended. And but for other entrepreneurs to connect with each other, I think it's a great idea if it works, right? So it has to. If I ask a question and I don't get a good response, I'm not coming back, right? I might try twice or 3 times, but if I don't get really a good response, I'm not coming back. And what's the incentive too for the people answering the question, right? So how is it helping them? So everybody does stuff in their, all of our time is valuable. As an entrepreneur, you're very busy. It's not just me who's busy, all of you are busy, right? But we all have our priorities on where we spend our time, right? And usually we prioritize by what will get the biggest return for us. Like for an entrepreneur, it's for your business. For me, it's for my business, right? So how will this really give them a return? You need to think through that. And there's a lot of forums out there already on the web where people do question and answer. There's Quora. Quora has tons of experts on it answering questions and lots of questions. So how is this going to be better than Quora? How is this going to be better than all these other message boards that are already out there and websites? So I know you said AI, and that's why I said, does it work? Like, I can't answer your question because I know this is valuable. I mean, sites like Quora are doing very well, but and they don't really use any AI. It's just question and answer. But can you improve it through AI? I'm absolutely sure you can. Is it easy to do? I'm absolutely sure it's not easy to do because nobody's done it. Nobody's done it well.
Okay, thank you very much. Thanks.
So one more question, and then maybe 2, depending on how long. I can't hear anything.
Oh,
did you mute
sorry.
it?
No, sorry. The question is from Singapore. What are your top 3 red and green flags when talking to a founder first time?
So that's a great question. So red flags there's a lot of red flags, but I will give you a couple. So big red flag is where I ask them some basic questions. Like I say, who are your competition? Remember I went over that? And they don't know their competition and they can't answer that. Big red flag, right? A big red flag is if I look at their teammates, who they've brought on board the company, and the people that they have surrounded themselves with aren't top tier, they're like second and third tier, they aren't really great, huge red flag. Like I want to see a CEO of a company, an entrepreneur who's surrounded by amazing people. Then I know this person is amazing. You know, the job of a CEO is to attract amazing people. If you don't get amazing people on board, you're not doing your job. So it's huge red flag. I probably won't invest. Another big red flag is, you know, when I ask them, have you talked to your customers? What do your customers think? And they can't tell me. They haven't spent time with their customers. They haven't gone out into the market. They don't know, or they might not even know who their customer is, and they're building the product. Huge red flag. Those are the three top red flags. Green flags, you know, I like entrepreneurs who can show me in the past that they've done something successful. It doesn't have to be a business, that they've organized something, that they've brought people together. It could be a club in college. It could be some, you know, they won this huge contest, you know, whatever it is. They were the top debater in their debate society. Whatever it is, they have achieved something. Achievers tend to repeat themselves. They achieve it over and over and over. That's one green light, and I'll give you one more green light. Another green light, perseverance. You know, I want to see entrepreneurs who don't give up. Doing a startup is really hard. Trust me, it's been really hard. Like, so I want to see somebody who in their past, like they just, you know, they hit an obstacle and they find a way around it. Those are the people at the end of the day you can count on. Thank you. One more question.
And one last question. Just a second. One last question from Africa, I guess. Fantastic webinar, Steve. Many thanks. Two questions. Do Chinese investors look for companies to scale globally or mainly domestically? And second, in the current circumstances, tensions between US and China, if you have a Chinese investor, do you have a problem to raise money in the US? I like this question.
Yeah, so great question. So, so Chinese invest in both, but the China market is huge. So literally, it's so big, you know, 1.4 billion people, that all you need is China. Like, if you're a unicorn in China, like, you got it made. Like, you don't need to go out to the rest of the world. But of course, if it's a global business, they're excited. But China is so different from the rest of the world. They're happy if, you know, you can be a success in China. And first and foremost, they're usually, most of the Chinese investors are investing in yuan, the Chinese currency, and they can't always get it out of the country. So they have to invest in startups that are set up and operate in China. Now, there are other investors who have currency outside the country, and then they can invest in companies that are international. And that's the short answer to that. In terms of China-US relations, it's been very strained. You know, Donald Trump has made you know, he's really damaged the relationship between the countries. And if you take Chinese money and you are on a certain, you have certain technologies and you have Chinese investors, it could be detrimental to raising capital in Silicon Valley. That wasn't the case a few years ago, but definitely under the current situation, it is the case. And a lot of the Chinese money was flowing into Silicon Valley, like pouring in. Now it's basically a trickle. It's like very little Chinese money. They're really, the two countries, the two ecosystems were really pretty intertwined a few years ago. And now they have decoupled to a large degree compared to before. And it's still, and then they're pulling apart even further. So my gut feeling is pick one or the other market. Like, first of all, it's too hard to raise capital in two markets at once. They're very different markets. Like, they're just totally different. And you need to invest a lot of time, like I said, in both markets to be successful. You only have so much time as an entrepreneur. Pick one that you think is right for your product, where you can reach, you know, where you will be valued the most, and go for that. If you don't succeed in that, then you can stop that and try the other market. That's my advice. Okay, thank you so much.
Thank you so much, Steve. It was amazing presentation. We value your time. We're highly excited for everything you've actually shared with us. We will use this for raising capital, and we're happy to speak with you later on any opportunities for our global community. And
wonderful.
In the meantime, I'll be happy to share any information with the community you may ask me. I'll just be happy. And on this note, I let you go, and thank you so much. For the community, please stay, and I'll have a few announcements. And Steve, if you have a few last words, just please say.
Oh, well, wonderful talking to you from all over the world. Once I can travel again, I hope to meet some of you in person. And thank you, Daniel. It's just wonderful to see you again. And I'm very happy now to be part of your community.
Thank you so much.
Take care.
Take care.
Bye-bye.
Goodbye.
Bye.
So everyone, last few announcements, just 1 second. Okay. So if you like this webinar, feel free to join our next webinar. There will be a lot of great talks. I, in the beginning, explained what talks we will have. If you're not on the community, first of all, I'm gonna say who are our partners who are helping us to actually make this happen. It's Rusbase, IB Consultor, Skolkovo Technopark, GSD Venture Studios, and Moscow School of Management, Skolkovo. How to join the community if you're not there? Just find us on Facebook, Go Global World, or scan this QR code. Just find the group of your country where your local community is, and it's like Go Global Russia, Go Global I don't know, Australia, Go Global Azerbaijan, Go Global South Africa, wherever. This is an example of local communities, so you can interact locally and globally. If you're in Russia or you speak Russian or want to be closer to Russian community, you also can join us on Telegram. It's Go Global Russia in English, and or just scan this QR code. We're also on LinkedIn, and we can professionally connect and help each other to go global. Just find Go Global World and or scan this QR code. And this video will be posted on the YouTube channel Go Global World. So as I mentioned to you in the beginning, we are a non-profit community. This is why it's very important you like this video. You discuss everything that is important in the video right in our comments, and share this content so more entrepreneurs can have access around the world to this amazing content for free. We want this content to help entrepreneurs anywhere they are. And it doesn't matter if they have resources or not. It's very important for our community. So if you need my contacts and you want to discuss something with me, here are my contact details. You can text me, or and we can discuss whatever questions you guys need. On this note, that's it. Thank you so much for attending, and see you next webinar soon. Goodbye.